Some of the concerns that the Canadian banks no doubt are facing are high levels of consumer debt and what that may mean on growth moving forward, concerns over the euro as we're seeing in the marketplace, and a slow economic recovery. And although these are concerns that everyone is dealing with in the marketplace, these also present opportunities. Canadian banks are in a very sound position as they move forward to be able to understand the various opportunities that are out there in the marketplace. And certainly through last year and currently we're seeing Canadian banks take advantage of various opportunities, whether that means acquisitions here at home or globally, or the beefing up of existing profitable operations. This report is an amalgamation of both qualitative and quantitative results, an analysis of the Big Six Canadian banks through October 31, 2010. It also explores various perspectives in banking as it relates to areas such as regulatory reform, opportunities and challenges for the Canadian banks.
This is a fantastic time for the banking industry to invest globally. The Canadian dollar is at par, the capital levels of the banks are quite strong, and also, frankly, the confidence of investors is quite high in bank stocks. But interestingly, if you look at the last 6 to 18 months in Canada, we've probably seen more acquisitions by Canadian banks than, frankly, we've seen in the last decade. And I think that's an indication that the banks realize this is a good time to buy. What's most interesting about it, though, is the banks are starting to be much more focused on certain strategies from a line of business standpoint and, in fact, from a geography standpoint. So some of the institutions are tending to focus more on capital markets and retail banking. Others are focusing more on wealth management. Some are looking at North America and South America, and others are focusing more on Europe and Asia. I think some of the barriers that the banks have, frankly, relates to capital level. So although the banks are, pretty well all the banks are in the top 50 from a capitalization standpoint, they really still have to pick their spots. There's only so many countries that they'll be able to invest in. And frankly, with the direction of regulatory change now, I don't think they'd want to invest in too many foreign jurisdictions. They want to be much more focused and be able to manage more effectively the divergent regulations that are developing. Now, from a domestic standpoint, the market's a little bit more challenging. If you look in particular at the last couple of years, a lot of the good growth rates that have happened in the Canadian banks have been fueled, in fact, by rising consumer spending and, frankly, rising consumer debt levels. We recently did a survey, looked at the levels of consumer debt and the comfort level of consumers in their debt levels. The good news is they are comfortable, they can handle current levels of debt. The challenging news for the banks is consumers are beginning to think, you know what, it's time to ratchet down a little bit the spending, and some of the acquisitions they might have made around auto, around housing and so forth, I think they're going to defer. What that means to the banks, they're going to have to look elsewhere for the growth. I think the big battlefield is going to be on the wealth management side, both in terms of products and services that can differentiate and help consumers to acquire more wealth management assets. And as well also, I think, on the retirement planning side, consumers are looking for more direction and more help in how they can plan for a future retirement.
Clearly, there's significant regulatory reform and change that we're seeing in the U.S. Some of that is going to move globally as well. There's continued deliberations around Basel III, which are the continued dialogue over enhanced capital requirements for financial institutions. These changes are very much in flux and moving. For example, in Dodd-Frank, there's a significant amount of legislation that is currently underway. And so although we don't completely understand what the impact is of all of these changes, there is certainty that this is going to take significant time of management to address, significant time for board members to be able to understand what this means to businesses, and there's going to need to be a very robust process around the assessment of what all of this means. For those banks who are operating in the U.S. or who intend to increase their operations in the U.S., they would need to very much take into account what these new changes are and assess their business model accordingly.
The two key dimensions are innovation of the business model and the operating model, and looking at global centers of excellence and opportunities to create scale and the benefits of scale, but also investing in technology investing in applications that are going to be used by consumers on the smartphones and tablet devices, investing in payment technologies that are going to enable mobile payments, investing in ways to interface with customers through social media and digital media. In some ways, the business has tended to be traditional in terms of the way that operations are undertaken, but we're just seeing more and more interest in innovative ways of thinking about how to take costs out, how to deliver more effective products and services, how to use the global network of supply to drive benefits. Outsourcing is not by any means a new phenomenon for banks, yet there are emerging alternative models for deriving scale benefits and cost benefits and potentially even revenue benefits. And these are models where banks look at doing ventures together in areas of operation where they don't really compete. It's more commoditized sets of services, often in the banking back office, if you will. So banks are really have become very open-minded to looking at areas of operation which historically have been somewhat sacrosanct. They've been part of what the banks feel they need to deliver themselves, but they've really opened their mind to considering different ventures, different business combinations to get at some of the benefits of scale and indeed improved effectiveness in the back office of banking operations. A lot of the banks that we work with, they want to be innovative because their clients, both business customers and individual consumers, value innovation and expect innovation and expect to be able to access the bank anytime, any place through a variety of channels and expect value-added services, not just transactional banking, but expect more and more advice through how they like to gather their information about banks or chat with other users in different communities. One thing that the banks are really focusing on thinking about today is how do they engage with their customers through some of these social networks or social sites where the consumers really dictate the terms. Traditional banking has been delivered through a very structured set of channels with a very structured, rigorous set of procedures around how you engage with your clients, how you communicate with your clients. What's enabled through social media is a lot of free-form discussions with clients that can have a very broad impact in terms of your brand, the degree to which your customers view you as being transparent and authentic. So this causes a challenge from the traditional model. There's really this focus on how do you move from a very controlled and structured set of operations and procedures around communicating with customers to something that you can still deliver your brand value proposition to your clients, but through a channel with less structure. Consumers very much value the advice that they get from their bankers and value that relationship, that trusted advisor relationship. What we've also learned is that delivering an integrated or an umbrella credit product to those consumers requires a very in-depth conversation. There's a lot of sophistication behind these products. There's the potential to make a lot of important decisions about how you use the products. So it really does require a lot of advice. That advice, as we've learned, is what really keeps a relationship very sticky for a bank. And it also provides you the opportunity to deliver other products and services from other business units, potentially within the bank. The banks are in a very enviable position by virtue of the way that they've come through the credit crisis, by virtue of the way that they've managed themselves from a risk perspective. There's no doubt our regulatory environment has been very supportive of that as well. The net of all that is the banks are in a very enviable position, particularly relative to some of their counterparts in the US and Europe, which continue to struggle. Canadian consumers have a lot of confidence in their banks, and they should have a lot of confidence in their banks. And going forward, we should expect to continue to have a top-tier banking environment here in Canada, and businesses and consumers will benefit from the strength of our banks.